First Gen Wealth, we talk about an entrepreneur's journey to creating wealth. I've got a lot of friends, a lot of colleagues, a lot of peers that they're brought up with money and the ability to handle and figure that out. Finding dollars has always been easy. Finding a deal, making money, I can do that. What to do with it to make it continue to earn so we do have that generational wealth, that's the missing piece. We want our money that we've earned through blood, sweat, and tears to now go to work for us. So that money is making money while we're sleeping. Hello and welcome to First Gen Wealth. I'm Randy Woodworth. On First Gen Wealth, we talk about an entrepreneur's journey to wealth creation. And today I'm joined by one of my favorite bankers in the commercial banking industry, Dan Montes. Dan, welcome to the show.
Thank you. Appreciate you having me here.
So Dan and I met randomly through like LinkedIn or whatever, and our first meeting was a typical broker banker interaction where it's like, you know, we're gonna hold as a broker, I'm gonna hold my cards a little close to my chest. But then you started talking about Star Wars, and dude, you had me.
Yeah,
right? You're a big Star Wars fan, right?
Huge Star Wars fan, been since a kid. So yeah, it was like magic when we started talking about Star Wars.
It really was. First thing Dan said when he came into the office today for this podcast, he noticed my lightsaber, my Obi-Wan lightsaber over there in the corner. So the Star Wars conversation continues.
It does.
But this is a conversation about investment and generational wealth and creating that. So Dan, I really either don't know or don't remember your story, but can you just tell the listeners how you got where you are in that industry right now? And then I'm going to get into a little bit further in depth, but how did you get where you are at First National Bank of Michigan?
Yeah, I started my banking career 15 plus years ago. I had a good friend who was a business banker. I was working at a casino at the time, and quite frankly, he was like, hey, I'm getting all the holidays off, and gives you a good work-life balance. We'll just say that, right?
Sure.
And so versus working graveyard shift, pulling 30-plus hour shifts. And so put my best foot forward, broke into the banking industry. Hey, like I said, it was, I think, 2007, 8, right in that ballpark.
Oh, that was a tough spot.
Yeah. Things were going good when I first got in, right?
Then
things went south really fast.
Yeah.
So it was a great time to learn what to and not to do.
Sure.
It gave me a lot of perspective from business owners and watching business owners who prepared for the worst.
Sure.
And those who lived like the best would never end. And so it gave me a lot of perspective. And I think where I'm at in my career now, where I gradually, was a branch manager, got in, small business banking and then commercial lending, which eventually landed me here at First National Bank of Michigan as a commercial lender as well. And so, again, just with that background, having that experience has really helped me open my eyes to how can I help my clients and set them up for a little bit of that future success. And again, prepare for things to not always be peachy.
Sure. So that's what we say in the brokerage side of things. If you survived that time period, that 2008, 9, 10, and you're still here, you probably aren't going anywhere until you decide you want to, right?
Correct.
So you've come through probably one of the most tumultuous times, and you were having banks call notes on investment grade property. I remember a client in the Lansing, Michigan area who was frantic because I believe it's Bank of America was calling his Walgreens note.
Oh, wow.
Which, basically what that means is the bank is telling you got to pay off your loan or you're going to give it back. So he's, trying to refinance with another bank. Of course, in this industry, Dan, right, the common standard is every 5 years there's a refi event. Usually. I mean, I would say if there's a typical loan in commercial real estate, it's probably that, where you're going to do a 15 to a 20-year amortization and then a 5 or a 7 year term.
I would say 5 or 7 term is pretty standard.
So there's a lot of, which is great for you guys in the lending side because you always got new business coming because we all got to refinance. But when those deadlines drop in the middle of some economic event like 08, 09, that's a problem.
Correct.
And I think that's something we're heading to potentially. Well, let's go there, man. what do you see over the course of the next 24, 36 months as all these guys, maybe 2 years ago, 3 years ago are into deals at 3.5%, now are going to have their terms come up and they're double.
Yeah, there's a lot of people who, I think it's going to depend on the market you're in for one,
Sure.
right? There's some markets that are still hot.
Yep.
And there's some who've cooled off quite significantly. And it also depends on the type of loan you did, right? What was your asset? Was it office space? Was it warehouse? Was it multifamily?
What was your leverage?
Correct.
Yeah.
And so those are all the factors you got to really look at. But, in terms of the next 24, 36 months, I would assume we're still going to see a few more rate hikes, unfortunately.
You think so?
Talking to some of my peers out there at other banks, I think everybody's in agreement that there might be a couple more rate hikes. We're hoping that there's not.
Quarter point Fed hikes, you're thinking?
Yeah. So we're thinking quarter to maybe a half.
So I try to read stuff that doesn't tell me that. I mean, because I feel like if we go too far and the buying, like the consumer really seizes and pulls back, you can get into a situation where we have deflation. And the Fed's always reactionary, right? Like it's always a year and a half behind where we are in the cycle.
Correct.
With the consumer. So I feel like they've done a pretty good job up to this point to hedge inflation. Like I feel like we've plateaued. And for me, I feel, personally, I think if they hike again, it may have a negative effect.
There's got to be that fine balance of how far do you push the envelope when you're trying to stem the inflation that's going on right now, right? And so the feds have to walk that fine line. It's not a job I'd want to have.
Yeah.
Right?
No. And you don't know what their thought process is. Maybe they do want a little deflation to have some pricing resets. That scares the poop out of me. But
let's talk the impact on commercial real estate.
Yeah.
Right? So, to your point when you were saying, hey, some people might not be able to afford it. So if you look at, I believe it was TREP was the data analytics group that collected the data, but they're saying there's $270 billion of loans, commercial loans that are going to come due by the end of this year.
Okay.
2023, right?
$250 million.
$250 million.
Yep.
Let's put that the Billy.
Yep, the
right?
Billy. I love saying that.
$80 billion of that is going to be office space that's coming due. So then we're looking at what's the negative effects. Who are the clients that are holding those buildings? Can they afford to weather the storm? And do they have the foresight to pivot and maybe do something different with that space, right? And so that's
well, and that may be coming to a head at it may all come together at the right time. I just saw Meta, formerly Facebook, announce that they're pulling the COVID policies of work from home. Like people are now going to be required to go back to the office. So maybe that, as more corporations start to do that, you'll start to see some of the balance in the occupancy. But, with some of those, more historic office buildings, a lot of those guys are pretty well leveraged. When I say well leveraged, they're not over leveraged, right? They're in like a 60-40 or a 50-50 situation where they can afford a little bit of vacancy. At the same time, these rates go back 10 years, go back 15 years. This is what they are.
Yeah, it's normal.
So, it's the guys that maybe syndicated and, really had 100% debt based on a syndication where they're pooling some dollars through other investments to meet their down payment, 3 years ago in a multifamily deal. And that was happening a lot.
Yep.
And now they're basically 100% leveraged because rates are only 3% and you can afford to do that. Well, we start to see some more rate hikes and pricing going down. That means rents could potentially go down and those things are going to be in trouble. So the multifamily is where I see the real problems. I don't think in retail you will see it. I think leasing is extremely strong. Tenants aren't affected by banking rates per se. Obviously, if they've got to do some construction, there's some effect there. But from a business model standpoint, we were just out at ICSC in Vegas for the retailers conference. There are some aggressive retailers looking to expand their footprint right now. So it feels like that at least inside these four walls. where retail leasing is still extremely strong.
Yeah, I think retail in general, the consensus is still holding steady and not really.
Well, it wasn't
giving up any
overbuilt
ground.
either.
Yeah.
It wasn't overbuilt. And so hopefully, I don't think we're going to have an event like we did before. I really don't.
No.
And when I say before, I mean 09, 10.
No.
Mostly because you guys, the banks, kind of learned a lesson there. And I think a lot of investors did too. So we're just a little bit more cautious and we're not getting in over our head.
Yeah, I think there were a lot of banks that during the '08 period, right, '08, '09, when everyone was questioning whether they were going to have a job in the finance industry, right? A lot of the banks learned from those mistakes, built up their balance sheets to be, as Jamie Dimon says over at JP Morgan, to be a fortress, right?
Right.
Fortress balance sheet. So you know that you can weather those storms. And a lot of banks put themselves in that position where they're, hey, we've got excess deposits. Now, I always say no bank can ever have excess deposits, right? You want more deposits. That's going to ensure that you are here tomorrow to serve your clients. And so, but with that being said, yeah, there were a lot of mistakes that were made during that period and a lot of lessons learned. And then you also had a lot of government oversight that has happened from a regulatory standpoint since then.
For sure.
All those combined together, there's very little chance we're going to see an '08, '09. I would be shocked if
I don't
something
think
was
so.
there.
It's going to be a one-off situation. It'll be minimal.
Correct.
And again, we came out of that, the rates were like zero, right?
Yeah.
So that wasn't really a rate thing so much as it was a leverage thing, And obviously we had tranches, that were being stacked. I mean, that it was a housing market thing.
But I am excited for the opportunity that will present itself over the course of the next couple of years, right? So we talk about there's potentially those who will not be able to afford going into it from a 3% rate to an 8% rate,
right,
or somewhere in that ballpark.
Right.
And so I think there's going to be a lot of opportunity for those people who've been sitting on cash and saying, hey, haven't found the right property, been waiting for it to happen. And keep in mind, properties were getting snatched up over the last decade at lightning fast paces because it cost you nothing to borrow the money.
Right.
Now that the opportunity is going to present itself, at least the way I see it, you're going to have some of those people who are saying, hey, you know what? I've got other properties. Maybe this one I don't want to hold on to anymore, or I need the money from this one, the equity out of the property, sell it to be able to keep these other properties afloat. So,
that's something I think is exact. Yeah, you probably hit on something there. They're going to leverage, dispose of a couple assets to make sure they can hold the premium ones they want to keep.
Correct.
And absorb some of that interest rate impact to buy down their leverage a little bit. That's probably a good point. So there will be some opportunities, some new stuff that'll hit the market, and hit it with the right pricing target, right, based on these interest rates. We're not going to have those 4 and 5 cap rates like we did in the past.
Yeah.
So Dan, this show is kind of about, the guy or gal that wants to start creating some supplemental income, investing, whether it's in real estate, business, or whatever. But let's talk about real estate. And I'm just going to kind of use a very brief example. And I want to kind of hear from you what the bank, what Dan Montes, what you are looking for from the borrower so that they can, and again, this is all, not in stone, but just a general consensus or a general outline of what the bank would be looking for when somebody's looking to borrow money on against an asset. So let's look at something like a 12-unit apartment complex, maybe valued at, let's go with $60,000 a door. So $720,000 asset. Let's assume it cash flows. How does that new person, what would the bank be wanting to see from that borrower to make something like that happen in general? And I know
in general, from a bank perspective, obviously you want to be a person who has good credit, right?
Yep.
Good.
Define that. And then without getting into the weeds, but what is 500 good? Is 600 good? Is 700 good? Or is it 640?
I think every it's unique to every client. We'll
exactly.
Just say that, right?
So a score is just if it's a score with a story, you can deal with it. All right.
Yeah. If there's a story behind it and we can explain certain things, absolutely. I think everybody still has the opportunity to move forward. A score again is just one of those initial indicators where if there's a conversation that needs to be had, you can have it, right?
Sure.
But again, then we also want to look at what kind of down payment are you making? What's the equity injection? What's your skin in the game?
Yeah.
Right. I think
Yeah.
that's probably one of the number one things a bank is going to ask is, what are you bringing to the table as the borrower, right, to make this deal work? The other thing you alluded to, cash flow, right?
Yep.
I think cash flow is king no matter what the situation is. But then if we're looking at multifamily, occupancy rate.
Sure.
Right? Occupancy rate is going to be a huge driver on that property.
Okay.
And it's also going to lend to the value, right? I think if you have a property that's sitting there 50% occupied for the last 12 months, there's a lot of explaining that needs to happen as to why that property's been sitting in that condition. But again, if you can show, hey, the property's been leased out every door for the last 12 months, or maybe even 90% rate, right? I think that's still outstanding rental rate. Those are things we're going to look at. But again, in general, it's what's the skin in the game. Mm-hmm. And then for those ones that are maybe we don't have as much money that you want to put into it, what's the background of the client, right? So if you are it's not your first go around, you've done several of these properties, those properties are successfully operating. Those are all factors that banks typically are going to consider when looking at a deal for a client.
It was a trick question because I know there's no typical deal, right?
There isn't.
So basically what you've got to do is if it makes sense for you as an investor, build it in a simple spreadsheet, and then you can sit down with somebody like Dan and work through the details of how we can present this to a lending board, if you will, to an advisory board to borrow. And now it might mean 15% or 20% or 25%, or in some cases, if the occupancy is bad, 30% down. But again, the more skin in the game you can have, the better the bank's going to, cast the light on that and probably do the loan. And it insures you against situations like the ones we're in right now. If you've got a little bit more down payment, a little less leverage, you can withstand some of the ebbs and flows of interest rates a lot better. But for properties that maybe you see an opportunity that can raise rents, have the conversation with the banker and come up with a solution, because they're here to lend. I know First National Bank of Michigan has been pretty creative, and I don't want to say creative in a sense that they're going to do things that other banks won't, but they will look at the overall story, right? And you will work with a client to make it fit into your lending strategy.
Right. And I think if you're working with a good banker in general, right, we're going to look at other avenues that we can help you too. If maybe the initial presentation isn't meeting all the criteria, but we are a resource where we can look at grants that may be available through different government economic programs.
Especially in
right?
multifamily, yeah.
Absolutely. So there's a lot of programs that are out there to help get some of that additional gap funding for projects. And it's free government money, right? And so we're always looking at ways to help you say yes, right? That's at the end of the day, we want to say yes.
Yeah.
And so if we can help put those pieces together and connect you with those resources, that's what we're going to do. And, so I want to put it out there for anybody who's looking to maybe get into investing and looking at commercial real estate as an option. If you want to do it.
That's it, man. So quit sitting on your ass and find something that makes sense, and let's start talking about it. Talk about it with the broker, talk about it with the banker. Let's start an activity, an action of putting some of our income that we've made through blood, sweat, and tears to work, so that it's making money while we're making money. Like
Absolutely.
Double whammy, exponential growth. Well, Dan, man, that's awesome. That was a whole lot of insight in a short amount of time. Probably going to have you back, but thanks for coming on the show.
Appreciate you being here.
I appreciate you, man. That's awesome. And maybe the next one will be a little bit less about banking and more about Star Wars. Anyway, this has been First Gen Wealth. This is Randy Woodworth and Dan Montes. Thank you. And join us next time. I'm not sure what the topic will be, but it'll be awesome. Tune in.